So I've launched a series of React videos that many of you have liked, and one of them in particular has over 1 million views right now, and it's a little short where I reacted to advice about Roth IRA contribution withdrawals. I made one simple point in that video about how the money you put in your Roth IRA, the contribution, can be taken out whenever you want, no taxes, no penalty. I have so many comments and people trying to contradict this and tell me I'm wrong, but I'm here to set the record straight, and Mandy asked for it. She said this guy should really correct all the information in the comments. It's wild. 1 minute in, Matt's already heated. LOL, I love these, do more. So that's what I'm gonna do right now. All right, here's M. Jensen coming in saying contributions have to stay in the Roth for 5 years before you can take it out. Not true. There's a 5-year rule about taking money of investment gains out of your Roth IRA. So for example, if I'm 57 years old and I put $7,000 in my Roth IRA this year, I can't take that out for 5 years until I'm 63. Even though I'm gonna be 59 and a half in 2.5 years, I can't take that out. But that's only the investment gains. That's not the original $7,000 contribution. So there are multiple 5-year rules that apply to Roth IRAs, but not one of them has to do with taking out your contribution at any time with no tax and no penalty. So let me make sure everybody understands that. Let's say for 10 years, you put $7,000 a year into your Roth IRA, $70,000 of contributions. Let's say your account is now worth $130,000. You have $60,000 of investment gains. You can take out that $70,000 of contributions whenever you want. You're 35, take the whole thing out, the whole $70K whenever you want. There's no tax, there's no penalty. You only have tax and penalty on taking out investment gains from a Roth IRA before you're 59 and a half. There's nothing more to it. Everybody's trying to make this more complicated than it is. Sebastian Casas says you can pull out your money, but you will also pay an early withdrawal fee on top of taxes. Again, everybody's confusing the contributions versus the investment gains. Or what they're confusing is traditional IRAs from Roth IRAs. If you put $7,000 in a traditional IRA, it's true, you cannot get that money out without tax or penalty. But I'm not talking about traditional IRAs, I'm talking about Roth IRAs. So the tax rules can be confusing, that's where everyone's getting off the rails here. But remember, the Roth IRA, you can take it out whenever you want, no tax, no penalty. And I'm just talking about the contribution amount, the $7,000 you put in your account every year. All right, now Josh Hartzler comes in and he saves me on a number of these, and he's been awesome in the comments. Kudos to you, Joshua. Says, only on the earnings, he's replying to Sebastian. You don't get taxed on your cost basis, your net contributions into the Roth IRA, because you already paid tax on those. Remember, when you put money in a Roth IRA, you do not get a tax deduction. The deal on a Roth IRA is, I put my money in, I get no tax deduction, but the money grows and comes out tax-free. This is different from a traditional IRA where you put the money in, you get a tax deduction, you pay less tax this year. If I put in $7,000 in a traditional IRA and I make $100,000, I'm only taxed if I made $93,000 because I got to deduct that $7,000 contribution from my income. So that's nice because I pay less taxes now. But that's traditional IRAs. So I'm not talking about traditional IRAs and when you can pull the contributions out. There are taxes and penalties for that. Roth IRAs, you never got a deduction. You already paid the tax. That's why Congress, when they created the rules, says, let's let them take it out whenever they want. The investment gains are locked down, but what they put in, they can take out whatever they want. All right, now McGuire from Nat says, I guess we're just forgetting about the 10% withdrawal fee for early withdrawal. No, there is no early withdrawal on contributions in a Roth IRA. There's no such thing. The contributions you put in, you can take out whenever you want. This is again specific to a Roth IRA. Do not confuse this with other accounts like traditional IRAs. All right, now J4K comes in and makes kind of a confusing point. He's on track, but he gets confused here. He says, this is for the gains only, right? Yes, that's right. The early withdrawal penalty is for the gains only. The original capital you put in, your contribution, there is no fee or penalty. Correct, that's right. Then he says, however, I thought you couldn't just strictly pull out the original contribution. It's a mix between contributions and gains. Okay, J4K is committing the classic blunder of using a other tax rule in the wrong scenario. There is a pro rata tax rule that applies to non-deductible traditional contributions that you convert to a Roth and a backdoor Roth IRA. If you didn't follow that, don't worry. It's another thing we're not even talking about here. I've got other videos on the backdoor Roth IRA. Make sure you click the link below if you're interested in the backdoor Roth IRA. That's for high income earners who can't do a regular Roth IRA. They have to do a non-deductible traditional contribution that they then convert to Roth, and there's a pro rata rule for that that sometimes can apply, but it never applies applies to taking out your contribution in a regular Roth IRA contribution at any time, even before 59 and a half. So don't worry about pro rata and mixing up those numbers and these rules. It does not apply to what we're talking about here, which is taking out your contribution of a Roth IRA whenever the heck you want. All right, now Top Shot 501 had a comment that said, this is why you have to declare your basis with the IRS every year for Roth IRAs to track what you've put in your Roths versus how it's grown. Now, generally you can pull up your account and look at your contributions with your IRA account provider versus your investment gains. It's easy to determine this. Some people in the comments are saying you need to look at Form 8606. No, that's for Roth conversions and this traditional non-deductible contribution being converted. You don't need to worry about Form 8606. Now, your IRA provider every year will send you, or it's available in your account in your tax document section, Form 5498. You can look at Form 5498 for every year you've had a Roth IRA. That tells you how much you've contributed every year. You could simply add all of those up. But again, most accounts, when you log in and you're like, well, Matt, I need to take money out of my Roth IRA. I've got 70 grand in the thing, but I don't know how much was contributions versus investment gains. I can't remember for the last 5 or 6 years what's what. It will say in your account, go log in. And at a minimum, if you have a crappy provider that doesn't do that, you can look up the 5498 that is done every year by your IRA provider. They typically mail it to you. Again, it's accessible in your account, and you can just add up the contributions for each year because it is on that tax form 5498 that is also, by the way, sent to the IRS as well. All right, and this is a really important question and comment here from True Wolf Winterfell. He says, thank you for this video. Over 10 different experts have answered when I pose this scenario to please consult with your tax guy. Now, one of those experts actually told me that money has to still sit for 5 years before you even withdraw your initial investment if you are under 59 and a half. I'm 40. Just open up a Roth IRA with Fidelity for 5K. What if I want the 5K tomorrow? This was my simple scenario. Thanks for this. Okay, True Wolf Winterfell, take the 5K out tomorrow if you want. Okay, I'm not saying to do that. This is what we're talking about. The ability to take it out if you want or needed it. It's only the investment gains. Let's say that account's now worth $6,000 because you had $1,000 of investment gains. The $1,000 locked up and you do have penalty and tax. But that 5K, no 5-year rule, no penalty, no tax. Take it out already. Don't worry. All right, now Steve Carden makes a fair point here. He says you can pull the initial investment out. It doesn't mean it's a great idea though. This is what an emergency savings account is made for. Totally agree, Steve. Okay, I'm on the same line with you. I don't want you to take money out of your Roth IRA. Just because you can doesn't mean you should, okay? But I want people to know that it is possible to take it out. If someone's 25 years old, telling them they can't touch the money until they're 59 and a half means they just don't save. So I'm telling people, look, there's this account. You can put $7,000 a year in it. Congress has told us if you use that account, when you make money, you pay 0 taxes. It's the only place you can legally make money, grow in wealth with investing and not pay any taxes. And it's a simple Roth IRA account anyone can freaking set up. But people get hung up because they're worried that they can't touch it till they're 59 and a half. I want people to know you can touch it. The contributions are available. I don't want you to touch it, but I want you to have the mindset that you can if you needed to, which will help you actually contribute and get started. That's the point I'm trying to make with this video. All right, see, now here's the point. At Dizzle1731 says, I'm in college, broke ASF, so am I able to take out a grand or two from my Robinhood Roth IRA without getting taxed or penalized? Yes, if that $1,000 or $2,000 was your contributions or more, you can take that out whenever you want. No taxes, no penalty. So if you're broken in college and you need it to pay your rent or to pay your tuition or whatever emergency situation you have, it is available to you. No tax, no penalty. Now I want to come back here and summarize the power of the Roth IRA. I've just been talking about one cool thing about it, but there's so much more to the Roth IRA. There's so many more reasons why it's cool and an amazing tool to grow and build wealth. The one little feature I've been talking about, taking out your contributions whenever you want, no tax, no penalty, that's just one cool thing about it. But here's the real power of the Roth IRA. Now, I want to contrast this with what many of you might know from a traditional IRA or a traditional 401k account. When you put money in a traditional Roth IRA, there's no deduction. I do not get a tax deduction for that. The government says, great, you put $7,000 in your Roth IRA this year. Good for you. No tax deduction. Now, if I put $7,000 a year in my traditional IRA, I get a tax deduction. If I made $50K that year, I'm only taxed if I made 43, okay? It reduces my taxable income in a traditional IRA. Now that's cool. You might be thinking, well, Matt, why is a Roth IRA better? I don't even get a tax deduction. Hold on here. All right, now as you invest the money in the Roth IRA, there's no tax on the investment gains. As I'm making money every year in this Roth account, investment gains, I'm selling stock or real estate or whatever I'm doing in the retirement account and I'm paying no tax, that means I get to reinvest every dollar. Now I get the same deal in a traditional IRA. They say when you're investing the account and growing it, you don't pay tax as you're growing. Now this is a huge benefit when you look at investing over a 30-year horizon for a retirement account because there's no tax along the way. I get to reinvest every dollar of profit and gain. But here's why the Roth wins. Once you hit 59 and a half, you can start pulling out the investment gains with no taxes. So I get to pull out the money, the contributions whenever I want. And once I hit 59 and a half, all the growth and all of the earnings over 30, 40 years of investing in the account, no tax. No tax at all. You get to keep every penny of it. Now here's the problem with the traditional IRA. I just want to contrast the two. Sure, I got a tax deduction to put the money in. I didn't pay any taxes, I grew it. But now that account's $1 million and I'm 59 and a half. Now when I start pulling money out, I'm paying tax on every penny. All my contributions and all my investment gains. Everything coming out of that account is taxable. Let me put this another way. Let's say you could have $1 million in a traditional IRA, or you could have $700,000 in a Roth IRA. What would you take? Well, if you're in a 30% federal tax bracket and a 5% state tax bracket, that $1 million, you're paying tax as you pull that out. That's only $650,000 in your bank account that you actually get to spend. However, that $700K Roth IRA, I get to keep every penny of it. That's the power of a Roth. A smaller account balance is actually more valuable than a larger traditional account balance. And that, my friends, is the power of a Roth IRA. All right, now I'm gonna end on this comment from Julie Burkott. It was really good. OMG, financial literacy is needed more than ever before. Crazy, keep up the good work, Matt. Well, that's what I'm doing every day here on the channel, so please make sure you're subscribed. We'll be correcting the record straight, what's going on TikTok and all this bad financial advice out there. But even more importantly, I'm giving you the strategies to save taxes, protect your assets, grow your retirement account, start a small business, and build your wealth here on my channel every day. Please make sure you're subscribed. We'll see you next time.